Friends, rule 15 and 16, of course, many times they also ask this particular question. What is this question? This pertains to partnership firm. First you have to value the assets of that particular partnership firm, then distribute that particular value among the partners. How do we carry it out? This is being given by the rule 15 and 16. Valuation of the interest of in the firm or association of persons. Because association of persons are the partnership firms are not taxable entities. So in respect of their assets, they are to be included in the assets of the net wealth of the partners or the members of that particular AOP. To the extent of the net wealth which is equal to the capital contributed by them, it must be apportioned in the capital contributed only. And over and above that, either in the dissolution ratio or in the profit sharing ratio, it is to be distributed among the partners. Write down rule 15 and 16. Rule 15 and 16. The value of interest of a partner oblique member in a partnership firm or AOP is to be ascertained as under. First, determine the wealth of the firm or AOP. Determine the wealth of the firm oblique AOP as per rule 14. As per rule 14. No exemptions should be given under section 5. Why no exemptions should be given under section 5, friends? Because these exemptions under section 5 will be given to the individual partner after this particular wealth is included in their assets. Subsequently, in their individual net wealth calculation, exemption under section 5 will come. Got the point? So exemptions prescribed under 5 should not be deducted while calculating the value of interest in the firm's assets or the AOP's assets. This is most important. Then next, portion of the net wealth as is equal to the capital, should be allocated in the proportion of the capital. Then residual value of net worth. Shall be allocated among the partners in accordance with the dissolution ratio, oblique profit sharing ratio. In the absence of dissolution ratio, it should be done in the profit sharing ratio. Then friends, one most important thing is, let us suppose that particular partnership firm is having assets both in India as well as outside India. Then if any of the partner happens to be a non-resident, so in respect of the assets which are located outside India, he will be getting a deduction. This happens only when if any of the partners are happens to be non-resident, normal way you have to calculate and distribute the wealth of the firm among the partners. So if one of the partner is a non-resident, then in respect to the assets which are located outside India, from that wealth of the firm which is given to that particular partner, you have to reduce those assets. Share in those assets you have to reduce. So write down, where a partner of a firm is non-resident, where a partner of a firm is non-resident or non-citizen or are resident but not ordinarily resident, and the firm has got assets, located outside India, then the following shall not be included, in the net wealth of such partner, So friends, how do you calculate that? Friends? That is, such partners share in the assets of the firm, write down, such partners share in the assets of the firm divided by net wealth of the firm, whole multiplied by assets of the firm located outside India, minus debts incurred in respect of such assets, or less debts incurred in respect of such assets. Of course, to understand this, friends, you please take one example. Write down, the net wealth of the firm, consisting of the three partners, A, B, C, having equal share and capital contribution, of rupees 7 lakhs, 3 lakhs, 2 lakhs is as under. A, value of assets located, outside India, 20 lakhs. Then next, value of the assets located in India, 50 lakhs. Then debts incurred in relation to assets located in India, 10 lakhs. 10 lakhs. Compute the interest of the partners. Compute the interest of the partners in the firm, assuming C as non-resident. Assuming C as non-resident. How do you go about, friends? First, write down the solution also in this particular problem. Net wealth of the firm. How do you calculate the net wealth, friends? Both assets located in India plus outside India minus debts. That is, brackets you write net wealth of the firm, brackets 20 lakhs plus 50 lakhs minus 10 lakhs. That and all makes it to be 60 lakhs. Then 4 columns you put, one is particulars column, another is ABC. Particulars column ABC. How do you go about? Up to 12 lakhs. Up to 12 lakhs. What is 12 lakhs, friends? Their capital. 7 plus 3 plus 2 is 12 lakhs. So for the A you write 7 lakhs. For the B you write 3 lakhs. For the C you write 2 lakhs. Then, friends, balance 48 lakhs. What is balance 48 lakhs? 60 minus 12 is 48 lakhs. Balance 48 lakhs in the profit sharing ratio. What is the profit sharing ratio, friends? That is, they are equal partners. So 16 lakhs, 16 lakhs, 16 lakhs. So put together how much? For A it is 23 lakhs. For B it is 19 lakhs. For C it is 18 lakhs. Now, friends, from C only you have to reduce for the thing which I explained. That is, this particular firm is having assets located outside India. In those assets located outside India, what is the share of Mr. C? How do you calculate? Write down. Value of interest of Mr. C. Value of interest of Mr. C in the assets outside India. That is, how do you calculate that, friends? 18 lakhs in divided by 60 lakhs multiplied by 20 lakhs minus nil. 20 lakhs minus nil. That and all works out to be 6 lakhs. So on that pretext, only adjustment is required for C's interest in the firm. So value of interest of C in the firm's assets, value of C's interest in the firm is 18 lakhs minus 6 lakhs, that is 12 lakhs. Minus 6 lakhs, that is 12 lakhs. So that's how we are moving from that particular rule. Of course, friends, on this we will be doing some problems when we do the exercise of previous examination questions. At this juncture, just to explain you that particular provision, I did with it, but much more complicated problems we can do from the previous suggested answers. Next, rule 17, write down valuation of life interest. Valuation of life interest. See, I have got an annuity policy, life policy. I am getting regularly the income, so that policy is to be valued. How do I do that? That's what is given in the value of life interest. Write down the value of life interest of the SSE. Value of the life interest of the SSE. Formula is what? Average annual income into brackets 1 divided by P plus D and minus 1. Average annual income into 1 divided by P plus D minus 1. Not D minus 1. The whole fraction, that whole this thing minus 1. So D is equal to rate of interest divided by 1 plus rate of interest. Rate of interest divided by 1 plus rate of interest. So our rate of interest, what you say? I divided by 1 plus I. D is equal to I divided by 1 plus I. Then P is equal to annual premium. P is equal to annual premium for whole life insurance. For whole life insurance without profits on the life. Without profits on the life for unit sum assured. For unit sum assured. That average annual income you need to take for 3 years. So for the 3 years, what is the average? You have to take the average annual income from that particular policy. Like that you need to value it. This also we can do one problem in case if it is being tested in the suggested answers. As far as the valuation of jewelry is concerned, rule 18 to 19, write down rule 18 to 19. Rule 18 and 19, valuation of jewelry. What is it, friends? Here of course just listen, there is no need for writing. When you have got a jewelry whose value is less than 8 lakhs, a simple declaration in form 08A is enough. In case if the value of the jewelry is more than 5 lakhs, you have to go to a registered valuer and get the valuation done and submit the particulars in form 08. And here try to understand, once valuation is done for 4 subsequent assessment years, there is no need to again make a fresh valuation. Unless and otherwise, the value of such jewelry, if you feel is increased more than the value stated in your valuation certificate, then you have to voluntarily do it for that increase. If you make sale or again purchase some more jewelry, then you have to make proportionately the adjustment to the value given by the the registered valuer. In any case, the valuation once done for the next 4 years, it is not warranted, is what you have to understand. Even this point, once it is being tested there in the suggested answers at that place, anyhow you have to write for some theoretical questions also the notes that we will cover at that juncture. Of course, not great, not being explained here is being going to be taught there. It is being fastly being explained here, slowly it is going to be written by you there. Then friends, I move to rule 20, valuation of other assets. Rule 20, valuation of other assets. Here also try to understand where a particular asset is to be included in the net wealth, for which the other rules are not applicable, this rule is applicable. And more particularly in case of the house property, what you said, in case if the unbuilt area is more than the specified area, over and above what percentage? 20% or what? What is the percentage above which you have to go by the rule 20 valuation? More than 20%. Then you have to go by the rule 20 valuation, and rule 20 valuation says what? In respect of the assets for which specific valuations are not, specific rules of valuation are not there, you go by the fair market value. And similarly you have got rule 21. What rule 21 says is, ignore any restrictions on the property. Let us suppose there is a property, somebody gave that property to me stating that I can make sale only to so and so person, and that too also for so and so value only. Then I say that since this particular property deed says that it can be sold at a later date only to so and so person and for so and so value, so that value only I will adopt for wealth tax purpose. If there are any restrictive covenants, then you should ignore those restrictive covenants and you should take the market value of that particular asset is the point. So those are the aspects with respect to the, what is it, the valuation, which is a very mega exercise. Of course, as a student, if you ask me, three aspects you should be very clear: valuation of immovable property, valuation of interest in the partnership firm, and these two are very, very important. Similarly, for a business balance sheet, if it is there, business is there, then from that business balance sheet, how do you value the assets for the purpose of wealth tax? Rule 14. There it is stated, either the written down value in case of depreciable assets, book value in case of non-depreciable assets, stock in a trade, more than land is held as a stock in trade for more than 10 years, you have to go by rule 14, or schedule 3 valuation for the corresponding assets, whichever is higher you have to adopt that. So these are the important things with respect to the valuation. Now I come to the assessment procedures under the Wealth Tax Act. Friends, try to understand, that is your wealth tax assessment procedure and your the income tax assessment procedures more or less are same except for few things. That is, what is the date of filing, the due date for filing the return? That is 31st July, and in case if your accounts are to be tax audited, or if you are a company SSC, then 30th September. If you are also having a, foreign transactions where you are to furnish a report under section 92E, then due date for filing the wealth tax return is 30th November is a point. Who has to sign the return? Individual himself. If he is absent, then a person duly authorized by him. And where the person mentally incapacitated, then the guardian kind of thing. And then in case of Hindu undivided family, Karta, and if Karta is absent in India or incapacitated, then any other adult member. In case of the company, it is a managing director, or where there is no managing director, then any person duly authorized by the company on this behalf to sign. As far as payment of the wealth tax is concerned, for a delay in payment of the wealth tax, there is an interest at the rate of 1% for every month commencing from the date immediately following the due date and ending with the date of furnishing of the return. For that particular period, interest is to be levied. You don't have 234B and 234C interest here under the wealth tax, because under the wealth tax there is no concept called as advance tax. But for that, friends, your obligations to file the return, belated returns, revised return, signing of return, self-assessments, intimation and deemed intimation, notice before making the scrutiny assessment, best judgment assessment, income escaping the assessment, time limit for issuing the notice for reassessment, interest for late filing of the return, penalties, power to reduce the penalty, and revisionary powers of the commissioner, except for sections being different, all those things which are stated under the income tax law are equally there here also. Of course, there are few provisions here. That is in case if your net wealth is below the maximum limit, that is 30 lakhs, there is no need for furnishing the return. It shall be deemed to have been furnished, never to have been furnished. Maximum amount which is not chargeable to tax shall be deemed never to have been furnished is a point. And then friends, point is like a company is liable to file the return of the wealth only if its wealth exceeds 30 lakhs, whereas under the income tax law, even if a company or a partnership firm is incurring a losses, filing the loss return is also mandatory. Then what is it? Penalty. Penalty, what we are saying, there under the income tax law it is 100% to 300%, whereas under the wealth tax law 100% of the tax ought to be evaded to a maximum extent of 500% of the tax ought to be evaded, one can levy. Similarly, here you don't have the advanced tax concept, so consequently there is no 234B and a C interests. So, and under the wealth tax, the wealth must be rounded off to the nearest 100 rupees, not 10 rupees. So these are few differences between the income tax law and the wealth tax law. More particularly, you have to understand the penalty concept which is given in section 19. That is, do the power is there. That is one important issue there, which I will also make you write when we read the suggested answers is, let us suppose a person died, his legal heirs are there, penalty proceedings are initiated against what is it that deceased person. Will those penalty proceedings can be continued against the legal heirs of the deceased? Under the income tax law, yes, whereas under the wealth tax law you can't continue with the penalty proceedings on the deceased person over to the legal heirs of such a deceased person. That is one important thing you have to remember. So tax of a deceased person payable by whom? Legal representative, but the penalty proceedings initiated against that particular legal heir, against that particular deceased cannot be continued. Who said so? Section 19 says so. Of course, is section 19 specifically says so? No, indirectly it says so, right? Of course, the provisions of section 14, 15, 17 with respect to the filing of returns, assessment, reassessments, what are all applicable to the deceased person are equally applicable to the what is it your legal representative also. But this penalty which is specified in 18, section 18, that is not being stated in section 19 that legal representatives will also be liable for the penalties levied on the or penalty proceedings initiated against that particular deceased is a point. That is one thing. Then assessment in the case of executors, that is executors to the property should file the return apart from their own individual return. Then assessment after partition of the HUF up to the date of, even under the wealth tax law also, friends, please do remember section 20 deals with this particular issue. That is, even under the wealth tax law also, that is it recognizes only complete partition, partial partition is not being recognized. So in case of complete partition, up to the partition HUF need to file the return. Subsequent to the partition, in respect of the assets which the individual members got, they have to include them in their net wealth and should offer the tax on it. And partial partition is not being recognized. And then friends, we have what is it, the assessment in case of diversion of property or income from the property held under the trust for public or charitable or religious purpose. Public or charitable religious purpose के लिए एक trust और लगा दिए. So trust is holding some assets. If those assets are used for charitable or religious purpose in India, then it is not to be treated as an asset. And if it is proved that any part of those assets or income from that particular asset is being utilized for the benefit of that particular author of that particular trust, or that the trust is not carrying out the charitable or religious purposes, where exemption is withdrawn under the income tax law, here what we say in respect of, in that situation, yes, with respect to those assets, the trust needed to pay the wealth tax. And how it is, trust is going to be assessed in such situation, trust will also be assessed just like an individual only is a point. Of course, with verbatim, anyhow, you are going to write when we discuss the suggested questions. Assessment of the persons residing outside India, they are supposed to appoint an agent. Who is an agent? Who is an agent? A person who is employed on behalf of that particular non-resident, or any person who is through whom the non-resident receives the income, or any person who is in the possession or custody of the assets belonging to the non-resident, that person is said to be an agent. And in respect of the non-resident, it is the agent who is supposed to be the deemed assessee. He has to file the return on behalf of the non-resident apart from his own return. Then liability of the transferee of the properties in certain cases. The last session also I concluded with the same remark, stating that yes, in respect of the clubbing of the net wealth and all, after the clubbing of the net wealth, in case if the assessee is unable to make the payment of the tax in respect of the clubbed assets, the transferees of those assets need to pay the tax, and department has got full right to recover the tax from them is a point. So overall we have covered the wealth tax conceptually, and one more session of 4 hours duration we will go to discuss as many questions as possible, but I have in my list about 52 questions, but to the extent possible I will try to do the justification in the same lines how I did for the profits and gains from business and profession. So there also the session is being planned in 2 different ways. One is one complete 2-hour session on theory questions from this particular topic which are being tested in the exam. Then at the end 2 hours we will spend with some practical problems which are being tested there. Thank you.